Every time the Federal Reserve cuts rates, people ask the same question: which asset wins? But that question is wrong, because rate cuts don't create winners. They reveal stress. And every time the system tries to ease its way out of trouble, something breaks first. In this video, I'm going to show you why silver reacts differently than gold, why rate cuts are a warning rather than a rescue, and what silver is quietly telling you about the next phase of this cycle. The Federal Reserve is often described as the most powerful institution in the world. It sets interest rates, it controls liquidity, it decides when the economy slows and when it accelerates. That belief is comforting, because if someone is in control, outcomes feel manageable, predictable, and contained. But history tells a very different story. The Fed does not guide the system forward. It reacts to damage already done, and by the time it reacts, the consequences are already embedded. This is not a story about policy success or failure. It is a story about trade-offs that can no longer be avoided, and about why, in every major easing cycle, silver ends up doing something gold does not. When the Fed cuts rates, it is rarely a sign of strength. It is a signal of stress. Something in the system has broken or is about to. Credit tightens, growth stalls, leverage becomes dangerous. Rate cuts are not stimulus. They are triage. We have seen this pattern before. In the 1970s, rates were cut to manage inflation and recession at the same time. Currency was diluted, purchasing power eroded, and silver exploded. In the early 2000s, rates were cut to cushion the collapse of the tech bubble. Asset prices recovered, debt expanded, and the foundation of the next crisis was laid. In 2008, rates were cut to zero. Liquidity flooded the system, confidence returned, and silver eventually outran gold. Each cycle looked different on the surface, but they all left the same scar: more debt, less policy flexibility, and a system increasingly dependent on materials that monetary policy cannot create. In a moment, I'll explain why silver responds more violently than gold, why that volatility is not noise, and why this cycle is more constrained than any before it. Because silver is not reacting to policy decisions. It is reacting to limits, and this is where the problem becomes structural, not cyclical. This is the trap. The Federal Reserve cannot normalize policy without destabilizing the system it has spent decades stabilizing. Interest costs alone make that clear. A heavily indebted economy cannot tolerate sustained high rates without breaking something important. So the choice is always the same: tighten until something breaks, then ease. That easing does not collapse the dollar. It dilutes it. Currency dilution is subtle. It does not feel like crisis. It feels like prices rising slowly, assets inflating quietly, wages lagging persistently. This is why most Americans do not experience inflation as an event. They experience it as erosion. Gold responds to that erosion first. It reflects distrust in currency. It preserves value across cycles. Silver responds later and more violently because it reflects something else as well: the interaction between monetary dilution and real-world demand. When rates are cut and liquidity expands, capital flows outward, into assets, into infrastructure, into consumption. That activity increases demand for silver at the same time currency weakens. Gold feels the monetary side. Silver feels both. This is why, historically, silver outperforms gold during major easing cycles. Not because it is safer, but because it is more exposed. It sits closer to the real economy. It reacts not just to fear, but to activity fueled by easy money. The Federal Reserve does not decide this outcome. It enables the conditions for it. Every time rates are lowered to protect growth, the system becomes more dependent on materials that cannot be created by policy. More grids, more electronics, more automation, more silver. At the same time, the value of the currency used to price that silver weakens. This is a powerful combination. It is why focusing on inflation numbers alone misses the point. Inflation is not the cause. It is the symptom of a system stretched between debt, growth, and physical limits. Silver does not rise because the Fed wants it to. It rises because the Fed has no clean exit. Monetary easing delays pain, but it also deepens dependence, and dependence eventually expresses itself through scarcity. This is why asking whether the Fed will pivot misses the deeper question. The pivot has already happened. It happened when debt became too large to unwind without consequence. From that moment on, the path was constrained. Gold protects against that reality. Silver exposes it. And in every major cycle where policy tries to soften the blow, silver eventually reminds the system that not everything responds to interest rates. Some things respond only to limits. Those limits are what ultimately decide who wins. Not the Fed, not policymakers, not markets reacting to speeches. Limits. The Federal Reserve can lower rates, raise rates, pause, pivot, signal, reassure. It can influence behavior at the margin. What it cannot do is change the structure it is operating inside. And that structure is now defined by three forces moving in the same direction: high debt, persistent deficits, and an economy increasingly dependent on physical inputs that do not respond to monetary policy. This is why the question "who wins" is the wrong one, because no one is winning. What is happening is adjustment. When the Fed cuts rates in a heavily indebted system, it relieves pressure in the short term. Asset prices stabilize, credit flows resume, growth limps forward, but the cost is paid elsewhere, in purchasing power, in currency credibility, in future flexibility. Silver responds to that trade-off with unusual sensitivity. Gold is passive. It reflects loss of trust. It preserves value as money weakens. Silver does that too, but it also reacts to what easing unleashes: more construction, more electrification, more consumption of the very metal whose supply is constrained. This is why silver's response to easing cycles is asymmetric. It does not just rise, it accelerates. In macroeconomic terms, silver sits at the intersection of monetary debasement and real economic expansion. When policy pushes on both at once, silver absorbs the force. That is why silver often looks too volatile during easing cycles. It is not overshooting. It is repricing multiple pressures simultaneously. This dynamic makes silver uncomfortable to hold psychologically. It does not behave like a pure hedge. It does not move smoothly. It exposes the instability policy is trying to mask. But discomfort is not randomness. It is information. The Fed's tools were designed for a different era: a lower debt load, a more elastic supply base, an economy less dependent on electrification and material intensity. That era is gone. Today, every attempt to stabilize growth through easing increases dependence on constrained inputs. Every attempt to manage debt weakens the currency used to price those inputs. Silver does not benefit because the Fed is reckless. It benefits because the system has boxed itself into a narrow set of choices. Gold remains the anchor. It holds value across time. It signals distrust. Silver is the accelerant. It translates that distrust into real-world pricing pressure. So when people ask whether the Fed will cut rates, pause, or reverse course, they are asking the wrong question. The question is whether the system can reduce its dependence on debt and material intensity at the same time. So far, there is no evidence it can. And until that changes, silver's role remains intact, not as a winner, but as a messenger, a reminder that monetary policy can move prices, but it cannot suspend reality, and reality always collects its balance. That balance is never settled in the language of policy. It is settled in the language of constraint. The Federal Reserve can delay reckoning, but it cannot eliminate it. Every easing cycle pushes adjustment forward in time while increasing its eventual magnitude. That is the quiet arithmetic of debt. Silver reflects that arithmetic more clearly than almost any other asset. When rates are cut, capital becomes cheaper. Projects that were marginal become viable. Infrastructure expands. Electrification accelerates. Technology scales. All of it increases demand for silver at precisely the moment the currency used to price it is being diluted. This is why silver does not wait for inflation to become obvious. It moves as soon as the incentives change. Gold protects against what has already happened. Silver reprices what is about to be locked in. This is the distinction most macro commentary misses. Inflation data is backward-looking. Policy is reactive. Markets at their best are anticipatory. Silver sits close enough to the real economy to feel those anticipations early. That is why, across history, the largest silver moves follow major monetary easing. Not immediately, not cleanly, but inevitably. It is not because silver is better money. It is because silver is money under pressure from reality. The Federal Reserve did not choose this outcome. It inherited it. Decades of compounding debt reduced the range of options until easing became less a choice than a necessity. Once that threshold is crossed, outcomes stop being discretionary. At that point, assets do not win because policy favors them. They win because the system needs them. Silver is one of those assets, not because it is fashionable, not because it is scarce in absolute terms, but because it sits at the intersection of what the economy wants to do and what it can physically support. Gold will continue to hold value as trust erodes. It will remain the reference point, the anchor. Silver will continue to reflect adjustment. It will remain volatile, uncomfortable, and revealing. So when asking who wins in a world of rate cuts, inflation, and a rising debt, the answer is not an asset class. The answer is constraint. Constraint always wins. And silver is how that victory shows up in price. It will remain volatile, uncomfortable, and revealing. So when asking who wins in a world of rate cuts, inflation, and a rising debt, the answer is not an asset class. The answer is constraint. Constraint always wins. And silver is how that victory shows up in price.